You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Thank you for tuning in to Mining Stock Education. I'm your host, Bill Powers, and in today's show, we are going to be hearing from veteran fund manager, author, and resource investor Adrian Day of AdrianDayAssetManagement.com. Adrian, welcome back onto the show, and you cover gold. So the first question will be related to gold, but not just gold, also inflation. In your estimation, how much anticipated inflation is built into the current gold price?
Okay, well, thank you, Bill. Thank you for having me. And I have to say that I always enjoy your interviews. They are always among the very best I do. And part of that is because you always ask interesting and unexpected questions. Inflation and gold. I honestly don't think that very much inflation is built into the gold price. And of course, there's no way of telling that unless you had sharp spikes in inflation and sharp drops in inflation on a monthly basis, where you could correlate that with the gold price. But my sense is that there's not a lot of inflation built in. And partly that is because, of course, after 2000, if you're basing your expectation for high gold prices on what the central banks are doing, then people look to 2009 onwards and say, well, we had huge explosion of the money supply back then and nothing happened to inflation. I think there's reasons, logical reasons, we can talk about later if you want, but logical reasons to say, oops, I was nearly going to say it's different this time. Those are the four most dangerous words in investing. But I think it's the logical reason to think that 2020, 21 are different from 2009, 10, 11, let's put it that way. But no, I don't think there's much built in, frankly. And it's the big question everybody talks about, both the gold bugs, if you want, or gold supporters, and the cynics, or the people who are skeptical about gold. Everybody talks about inflation. One side saying it's coming back, and the other side saying, look what happened after 2009. I think inflation is not as important to the gold price as both sides are imagining, frankly. That's another question as well.
So is it perceived purchasing power that gold, the saving of the purchasing power that gold can provide, is that the key driver where people flood into gold, do you think?
Yeah, I think absolutely. The central factor is what the central banks are doing around the world. The central banks are accommodating the unfunded spending of governments. And that, of course, picked up in 2020 over previous years. But it's a trend we've been seeing, no question. So yes, and that is, the dollar doesn't have to decline against other fiat currencies. It simply has to lose its purchasing power. And nobody, not even Janet Yellen and Ben Bernanke can dispute that the dollar has lost its purchasing power over the last 100 years since the Federal Reserve was created, and over the last 20 years, and particularly the last 10 years since they have started this policy of wild abandon with creating money. So that's the central thing. That can lead to inflation, as we typically define it, which is higher prices in the stores. But remember, inflation is not consumer prices. That's the result of inflation. Inflation is the increase in credit over the needs of the economy. And that can be evidenced in, for example, higher asset prices. And that's what we've seen over the last 10 years, whatever, since 2009, since the credit crisis. We've seen a huge increase in the money supply. It has not, until very recently, gone to households and small businesses. It's gone to money center banks. And for a lot of reasons that we can talk about if you want, but for a lot of reasons, banks didn't lend the money out. And so that money went into the stock market, antique cars, rare art, modern art, which shows you what side of that particular debate I'm on. But it went into assets, not into consumer prices by and large, because it didn't reach households. Now that more money is getting to households directly from the government and small businesses, and we can argue about the PPE program and how much of it is appropriate and how much really got to where it was intended and so on and so on. But more of the money is getting to small businesses and households. And once the COVID is over, during lockdowns, people didn't really have a lot of places to spend the money, or limited places to spend the money. Once the COVID restrictions are over and people go out again, I think you're going to see that money spent, not saved. And that's going to lead to higher inflation.
Adrian, from your study of economic history, I'm assuming we're in a stock market bubble right now, although it could go higher, because I thought we were in a stock market bubble back in 2015. But nonetheless, in fact, I remember the first time I interviewed you at PDAC 2017, I asked you about Dow 20,000 and what it meant. Well, that's so far behind us now. But nonetheless, when it comes to pricking the bubble, what typically happens, or is it always unexpected, or does it just happen as a course of history? What can you share with us about the topping of a major bubble?
That's a really good question. The thing about bubbles, of course, is that the timing of the end is sort of unknown. A bubble can continue getting bigger and bigger and bigger. Alan Greenspan was completely wrong in my mind when he said that, bubbles are only noticeable in hindsight. The bursting of the bubble is only noticeable in hindsight, but that doesn't mean it's not a bubble. So, first of all, the timing is unknown. What normally a bubble is burst by monetary tightening, not by a temporary exogenous event. So when we had the COVID hit Europe and then North America, we kind of ignored it when it was just China. We had a very sharp market decline, but then the market resumed its upward move. Clearly, the bubble wasn't burst by something like COVID. Now, if a pandemic that causes the economy, the government's used to shut down the economy, if that doesn't cause the bubble to burst, one might conclude from that exogenous events, however bad, are probably not going to cause a bubble to burst. So what causes it is monetary tightening. And there's typically throughout history, and there is no particular sign of that anytime soon. I think the odds are that the broad market continues to go up. If it was a simple yes or no, a coin toss, I'd say it's more likely to go up because the Fed's going to continue to create money, and some of that's going to go into stock market. But the problem with bubbles, even if you understand or can give a reason why they're happening, is that the longer they continue without the accompanying economic growth, then there's more risk in the market. That's the key. So when you're in a bubble, we don't know how high it could go. We just don't know how high it could go. What we do know for certain is that there's more risk. And when a bubble is pricked, it can happen or popped. It can happen very, very quickly. That's the problem. And everybody you talk to says, I'm going to, everybody thinks they'll be the first one out. They'll make sure they get out before everybody else does. Well, clearly, not everyone can get out before everyone else does.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near two producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold two companies in the past 7 years. Osino has a tight share structure, and with its current treasury, it can self-fund the advancement of its gold discovery into at least 2022. This is an exploration company with with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to OsinoResources.com. That's OsinoResources.com.
Since there's clearly no political will, at least here in the United States, for fiscal tightening, we're in handout mode. Is it the inability to print more money and do what they're doing? Essentially, is it going to be the decline of the dollar this time that could potentially bring it all down, bring the house of cards down?
Yeah, I mean, at some point, as you say, there's no political will at all. And it's not just here, it's in Europe and in Japan as well. And the theory seems to be, well, if printing a lot of money didn't solve a problem, the answer must be to print even more of it. It's time to go big, says Yellen. If we haven't been going big for the last 10 years, I'm not quite sure what we've been doing. But what can happen, what might happen is, as you say, we will continue printing enormous amounts of money until inflation picks up to a point where it can't be ignored. The Fed is preparing us for higher inflation by saying the 2% target is an average target. It doesn't mean once we hit 2%, we have to start tightening. So average over what? Average over, 2 or 3 years, or average over 20 years. And you know that they're going to delay tightening as long as they can. But at some point, inflation will be too difficult to ignore because the markets won't ignore it. At some point, the dollar, even though the dollar is, at the moment, as they say, the prettiest mare in the glue factory. My daughter doesn't like me saying that because she loves horses. But whatever metaphor you want to use, the cleanest shirt in the laundry basket, let's say that. At some point, people will turn against the dollar for whatever reason. It might be political reasons. We've seen a lot of that from China and Russia already. So at some point, people will turn against the dollar. There'll be something that causes the Fed to have to act, even though they don't want to.
Yeah, that makes sense. On a global level, because you invest globally, and I remember reading your book years ago, you look all over the globe for investments. What are some global themes that you could bring to my and my listeners' attention that you like right now?
Yeah, that's a really difficult question because, we invest in, we have both global accounts and resource accounts, gold and resource accounts. And I tell you, if someone gives me money for a global account, wants to be conservative in a global account, and I don't really need gold because I've got that taken care of, it's really difficult to construct a portfolio right now. Now, in hindsight, throwing darts at the newspaper or Barron's would have produced a gain. But so, the number one theme to me is gold, because what the central banks of the world are doing, and we'll talk about that, I'm sure, or we have talked about it, what the central banks of the world are doing is a perfect environment for gold to go up. So gold is the number one theme, without a shadow of doubt. The number two theme is commodities. And I know you want something broader than gold and resources, but the number two theme is commodities. Now, beyond that, I don't know if there's any broad themes, because those two take care of reflation. Those two take care of the reflation theme, if that's what happens. So we don't want to put all our eggs in the reflation basket. I'm looking at a few things. I'm looking at extremely beaten down markets, and believe it or not, there are some, like Hong Kong. Hong Kong has been extremely weak for known reasons, even as the Chinese market has continued to go up. So that's a bit of a dichotomy. If Hong Kong was falling with China, you might not want to invest in Hong Kong. You might want to wait to see what happens. So, there are some very, very cheap stocks in Hong Kong. Some of the real estate stocks are just ridiculously cheap. We can say that Hong Kong real estate is expensive and likely to decline. But when you've got real estate companies with residential, commercial, and office trading at maybe 25% of book, and trading at 3-4 times earnings, that's a huge cushion, So that's one. I think a second thing we're looking at is the British market. Ever since, it's not super cheap, but ever since the Brexit vote, the UK market has underperformed, the Morgan Stanley Capital International Index, world markets in general. And that's because of uncertainty rather than, shall we say, outright hostility to Brexit. It's just we don't know. And of course, the negotiations dragged on for years after the vote to leave. So I think some of those we're looking there, some of those companies are quite cheap. And by quite cheap, I'm talking about 12, 13 times earnings for the market and, stocks with 3 or 4% yields. That's not bargain basement for the British market, but certainly relatively inexpensive. I think those are the two main areas that we're looking at. And the third one I would just say is really just individual stocks from a bottom-up basis, and normally because of some temporary event that causes a particular stock to collapse. And it may. It's a temporary event, and you're looking.
So you have your eyes on GameStop here?
What? No GameStop. I live in Puerto Rico, as you know, and I've been buying the Banco Popular, which is the largest Puerto Rican bank, and that's good quality bank, good deposit growth, etc. So all the fundamentals are there, but I'm looking for a recovery in the Puerto Rico economy, which still is still in a recovery mode from Hurricane Maria, frankly, which is 3 years ago now. So it's just idiosyncratic stocks rather than any particular theme, to be honest.
I've been reading, Adrian, some articles on how we're looking at super cycle in commodities over this next decade. But I've also wondered, as I read the articles, what happened if we're going into a prolonged contraction, economic contraction? Can a commodity super cycle coincide with a global economic contraction?
That's a really interesting question. I think first of all, we need to sort of say what we mean by a commodity super cycle. And typically by a commodity super cycle, we mean a period of many, many years, at least 10 years, where all commodity prices, or certainly resource prices, go up at the same time over a prolonged period of time. And throughout history, every commodity super cycle that we can identify throughout history has been caused by a new source of demand. And that's important. And it may just be coincidence, but I think that's important to recognize. So throughout history, up until now, you look at 1825 to till the American Civil War, really. Commodities were in a huge move. That was, 40 years. What did I say? After the Napoleonic War is what I meant. After the Napoleonic War ended, you had a decline in commodity prices because they went up during the war, of course, because of increased demand, and they declined. And then from about 1825 to the American Civil War, you had that's over 30 years over 30 years of price increases. And that was caused primarily by the Industrial Revolution in Britain, which, of course, caused a huge increase in demand for raw materials. Second great one was 1870 to really the end of the First World War, which was caused by first Germany industrialization and American industrialization. So those two, the second and third at the time, second and third greatest industrial powers in the world, industrializing at more or less the same time, overlapping. That caused a huge increase in demand. Again, after the Second World War, you had a bit of a decline, and as the war spending ended, and then you had the industrialization in Japan primarily, and you had a mini commodity cycle. And then in the 60s, the other Asian commodities. And from 2000 onwards, of course, it was the commodity supercycle was primarily caused by the huge increase in Chinese demand. So the pattern has always been a new source of demand, not a sudden decline in supply. So I don't see that at the moment. I don't see that at the moment, unless we get it from, Indonesia, Brazil, and other, large, they used to be called emerging markets, but other large markets like that. What's interesting to me, and I'm giving you a long answer because none of these things are certain. What's interesting to me is that we could be heading into a period where a long sustained increase in prices is caused obviously by increased demand. We've had a recovery in demand from China. It's not a new source of demand, it's simply a recovery in demand. We'll get new demand from the US, perhaps with infrastructure spending, although every president for the last 6 has talked about how infrastructure is so important to him, but somehow the next election gets in the way of something that's going to not reap rewards for 10 or 20 years. But we could see more infrastructure spending. But I think we're at a stage now where for a lot of commodities, gold is certainly one, but for industrial commodities like copper in particular, and over the longer term, uranium and nickel and zinc, less so zinc perhaps, we have a potential deficit in supply. That was never the case in the past. If you think even over the last 200 years, you wanted there was always a new source of supply. South Africa and Australia are opening up, and the Canadian gold rush, if you're talking gold, and then the Carlin trend in the 60s. All of these were new sources of supply that met whatever demand there was. I think we've pretty much explored the world at this point. Now, there'll always be new technologies, for example, and one day we'll be mining from asteroids. But in the near term, I think the big sort of risk or opportunity is a shortage of supply that will cause the prices to go up.
Doré Copper Mining is a premier, near-term, high-grade copper and gold redevelopment opportunity with tremendous exploration potential only 14 kilometers from the town of Chibougamau in mine-friendly Quebec. Doré Copper is debt-free and owns a 2,700 ton per day mill with an 8 million ton tailings facility ready to be used. There is already power to site and it is accessible by paved highway and rail. Doré Copper aims to produce a profitable hub-and-spoke operation of over 100,000 gold equivalent ounces per year, or over 60 million pounds of copper equivalent by 2024. Because of the existing infrastructure and location, a low capex is anticipated to recommence production. Doré Copper trades under DCMC in Toronto and under DRCMF on the OTC. To learn more, go to dorecopper.com. That's dorecopper.com.
If I'm right that we could see an economic contraction, a prolonged one coming, then the safest commodities would be those where the supply side shortage is clearest.
You said it in 1 minute what I said in 10 minutes. Yes, absolutely. Absolutely. And those are the ones I'm focusing on. So if you look at, say, iron ore, there's no shortage of iron ore. It's just a matter of, the price, as we've seen in the last 10 years. But there's no shortage of it in the world, in places where you can go and mine. It's not all in Venezuela and North Korea. The same, ironically, for so-called rare earths. There's no shortage of rare earths. They're not that rare. But again, it's a matter of price. But copper, there is a shortage. And so, yes, you're absolutely right.
When it comes to your gold investments, I recently talked to Steve Letwin, the former CEO of I Am Gold, and he said as part of that interview that it's to be conservative, don't invest in gold projects or producers where their costs are above $1,200 per ounce, all in sustaining cost. What are your thoughts on that, Adrian? Obviously, that's not going for a leverage play, but based on the excesses of the previous cycle, that was part of the context of what he was sharing.
Right. And so you obviously answered the question. The irony in gold mining and other mining, the irony is when you start a new recovery or new rally or new bull market, at the beginning of that market, the worst companies sometimes have the best stocks. Because by worst, I mean the ones that are highly leveraged. They have a lot of debt and they have high cost of production. Well, clearly, if gold goes from 1,200 to 1,500, the guy producing at 1,300 has a much greater growth in his earnings than the guy that's producing at 600. So the leverage players are precisely the ones that do best at the beginning of a bull market. Now, and so the context of what he was talking about is obviously important. But, I think as an investor, I prefer to invest, and I'm being simplistic here, I prefer to invest in good companies. So the good companies will be those who manage to keep their debt low during a bear market that we had from 2012 to 2015, keep their costs low. And those will tend to be better managements. And those better managements will tend to do well, even once the leverage plays have, had their day in the sun, shall we say? So yeah, I mean, I think 12, and for me, 1,200 in the current environment. I mean, obviously, 1,200 to 1,800 is a huge margin for any business, but 1,200 is towards the high end of the cost curve right now. So, I would even look for companies that are a little bit lower than that.
Adrian, how do you approach litigation plays in the mining sector, like especially with the development project? I invested in Tahoe Resources before Pan American bought their Escobal mine. And after the huge crash in the share price, assuming that they could restart that mine, it's still been years later, they haven't restarted it. Or you get the permitting plays, the Pebble project, Northern Dynasty in Alaska. How do you approach these litigation, whether the permit's going to get issued or not, especially after there's been a steep sell-off and perhaps it's more attractive at that entry point?
Yeah, my experience is over 30 years now, and even before that, frankly, before I was managing money, when I was just investing and writing. Litigation plays always take longer than you think. What you call litigation plays. Remember Bob Bishop, he's a veteran of the industry, and, he always said, I'm not going to invest in litigation plays again. And, like him, I've been burned once too often, Crystal X in Venezuela, and we could name several. Now, so I don't invest in litigation plays. The only exception to that would be where I am very, very, very close to the situation. Now, it's a little bit different. Say you mentioned Escobal in Guatemala. Didn't want to invest in Tahoe, but investing in Pan American is a different situation.
Now it's a free option, right? It's a free option.
Yeah, it's a free option. Pan American has a lot of other assets. It's a good quality company at a good price anyway. Then you add on Escobal, and you add on Navidad in Argentina, both of which are basically free option. You ask 100 investors in Pan American, you're paying $33 a share. How much of that are you paying for Navidad? For what? For what? What's that? The mine in Argentina. Oh, I don't know about that one. Nobody's paying any money for that. So it's a free option. And Pan American has shown over the years that it is very patient. And they have made it absolutely clear on both of those projects. They're going to take their time. They're not going to bully their way through. They're going to take their time and wait until the local communities, in both cases, well, in Argentina, the local government as well as the community, but in Guatemala, the local community is on their side. And by the way, you said you had Tahoe. Did you get the takeover from Pan American?
No, I sold before. I couldn't wait. I think I had maybe a 20% loss or something. It wasn't devastating, but I did not hold it that long.
You would have got those convertibles, with the spinoff, PAASF, which is a little bonus they gave to the Tahoe shareholders. And if they have a finite life. If Esquivel is in production by 2028, then it's convertible at a certain ratio into Pan American shares. And the ratio right now would give you Pan American shares at about $16 a share. I shouldn't be telling everyone this because I'm buying them. Now, obviously, it's got a finite life. So if Esquivel comes into production in 2030, you've lost out, sorry. But it's a good way of getting Pan American on the cheap. So things like that, I will definitely do. But if it's a single asset in a litigation or a contracted permitting fight, my experience is just leave it.
Okay. And Adrian, last question before you go, because you're so bullish on copper, and we've talked about how there's the supply side deficit, but on the demand side, have you done any forecasts for how the electrical vehicle revolution might impact future demand for copper?
Yeah, I don't really, to answer your question, I don't really have an answer to your question, but yes, you're absolutely right. And that, when I talked about the commodity super cycles earlier, and we talked about new sources of demand, and in the past, they've always been geographic. I mentioned Britain and Germany and US and Korea and Japan and China. But maybe the super cycle or a segment of the commodity, the super cycle affecting a segment of the commodities will be caused by that new source of demand for electric vehicles. There's no question that the switch to electric vehicles, and it's not just electric vehicles, it's electrification in general, there's no question that is going to occur. It is occurring, and there's no question that it will continue. I personally I'm a skeptic on how quickly, the Ferrari driver will want to be driving an electric Ferrari at the current stage of development. But there's no question that that's happening.
Especially if it's quiet, right? Part of it is they want to be heard.
Quiet, yes. And I don't like Ferraris just for a record. They're sort of, here I am, listen to me and look at me. But the dirty little secret is not such a secret anymore, but the dirty little secret of the green energy folks is that all of the things they're advocating take more base metals to produce. So a typical electric vehicle uses about 4 times as much copper as an internal combustion one and 5 times as much nickel. And where does that copper and nickel come from? Where does it come from? It comes from mines. And that's the dirty little secret. So I think if we continue that drive towards electrification, we're going to have huge demand. And I can't quantify it at the moment because it just depends on how quickly it happens.
Excellent. Well, Adrian, your website is adriandayassetmanagement.com. For new listeners in particular, what can they find there?
Oh, we've got a lot of interviews, including yours. We've got a lot of interviews, videos, articles, as well as information about our services, of course. But, we pretty much post every interview I do. And we keep it there for a while so that you can see how wrong I was. All right.
So you have an honest track record then?
Yeah. I mean, yeah. I try to be honest. That's one thing I try to be.
There was no accusation in what I said.
No, I know. I'm trying to think of something clever to say, but yeah.
Well, Adrian, I'll reach out to you about 3 months. I really appreciate these frequent interviews. So thank you for coming on the show today.
Well, thank you very much for having me. I enjoy it. Thank you.